Yeah, so 2024 was obviously a giant year for stables. Total market cap surpassed its 2022 highs and is now sitting around $200 billion. Monthly stablecoin transfer volume is recently reached more than 3.5 trillion, which is like already rivaling or surpassing traditional payment networks like Visa. And we know that like a huge portion of that activity is people just using stables for everyday purchases, remittances, or businesses doing cross-border payments because the activity is largely uncorrelated with, BTC moves or moves in majors for the past 2 years.
Hey everyone, welcome to Messari's Thesis Pod. I'm joined here with Sunny and Andrew, who both sit on our enterprise research team. And right now we're going to be talking about DeFi, outlining kind of the year in review and then putting together some predictions for 2025. So I thought we would kick things off with the important topics right now, which is what are our Fartcoin predictions for 2025? Not financial advice.
I think Fartcoin to $5 has a nice ring to it, so I'm gonna keep that as my target for now.
Personal views, not financial advice. I think Fart is the one.
it's the one. Billions fart, but there's only one fart coin. Love it.
Billions. If you think about all the people that have to fart.
Yeah, it's like surprising that it's taken such a narrative in other people's like not TradFi, but normies' heads.
Yeah, pretty much like FinTwit is realized that they could get free engagement. They probably get more impressions on their Fartcoin tweets than their actual analysis. So it's a weird tipping point of no return for financial absurdity.
It's also just like the most, like if you're in the mid curve, which many people are, maybe myself included, but that's just a thing that you can talk about to make everybody else look stupid. Because it's like, why are people buying this? It makes no sense. That ends up spiraling into more mindshare.
So memeable, hot air rises, it hits. I guess coin discussion in the DeFi pod, given that for most of the year, it's felt like mindshare has gone to other places. DeFi kind of took a back seat, particularly in the first half. I'm trying to think of some highlights there. But when I look at 2024 DeFi, really the first three stories were Pendle, Maker, and RWAs. So I thought we could start there when going through what was their impact and maybe some future predictions tied to them.
Yeah, so why don't we start with Pendle, which is obviously all about yield trading, points programs, which kind of became a new vertical in itself for DeFi. But yeah, early on, it wasn't really just about trading future yield. It was mostly used as a wrapper for people speculating on points programs. And I guess the question now is, can yield trading actually stand on its own, or is Pendle just going to, continue riding the wave of future points programs? And are we bullish on those going into the future as well?
I think like the issue that Pendle, I don't know if it's an issue, but something that they run into is that crypto traders just demand like a very high return. So you didn't really see it take off until the eigenlayer points where people were getting 30% yield on the ETH that they were restaking. And so you kind of have this really high hurdle rate. And most of the time, that high hurdle rate is going to come from points programs. So I think you're almost reliant on points continuing. There's obviously like a standout non-points program, that use case right now, which is Athena. I think you're getting close to 30% there as well. So I think it's really dependent on, do yields continue to rise, which is dependent on, are we in a continued bull market where funding stays elevated, or are we going to continue to have people launching points programs and giving people the ability to farm that? So it seems like a cyclical use case at the moment until we get somewhere where we're willing to take on lower yields. But yeah, I don't know. Anyone else have any thoughts, or is that kind of what we're thinking?
Yeah, I think that the team definitely deserves credit. Like, they've made themselves very versatile and kind of durable by latching themselves to each new points program. So they're always kind of relevant regardless of whatever new meta or whatever is being launched. And I think they have an edge there over maintaining mindshare and usage because of that, over some of the more like single use case DeFi protocols.
That makes sense. I guess kind of continuing that, do we think points are here to stay? Like, is that going to be the main bootstrapping mechanism that we see in 2025?
I feel like post Hyperliquid, we will be eternally disappointed with new points programs. But like, it is a good way. Like, there's always going to be a cohort or like subset of like crypto native users who are going to try out new products. And it's just like I think generally it's a good like customer acquisition process. But, these products and platforms, they're not going to make or break themselves based on their points program. Like at the end of the day, the product has to be good. And like whether it doesn't really matter how rewarding the points program in the long term, if there's no good product that people want to use.
I think it just works. I mean, even in Hyperliquid success, you could probably give a decent amount of credit to its early points program. I think it ended up evolving into Hyperliquid just being an amazing product that people wanted to use even after the points program ended. But it just works. It's cleaner. There's also more flexibility for teams because there is that uncertainty of like what this means. You have a little bit more time to figure out what you want to do with the points, whether you want to extend the points program, how you want to end up. You have some time to figure out tokenomics. So I think it works very well. We'll probably see more points programs to come. And I think maybe the market should just I'm curious to know how like the market ends up perceiving points when they're using DeFi platforms, whether they see it as additional yield or whether at some point it's just a nice to have. But it's not a very reliable source of yield. I mean, you're just giving up so much certainty for what points might end up being or what they might be worth. So yeah, I guess on RWAs, Kinji, which were another trend this year that you covered a fair amount. I'm curious, what do you think about how RWA protocols and their perception have kind of evolved this year? I mean, you wrote a great piece talking about the spread between on-chain yields and off-chain yields and how with the interest rate increase environment, you saw off-chain yields being particularly exciting, or certainly worth a lot more than they were before, which kind of drove this interest in tokenizing T-bills and bringing RWAs on-chain. But that is sort of reversing at this point. So maybe can you just talk a little bit about that initial trend, that initial idea, and what you think the implications are going forward?
Yeah, so in my RWA pieces, I think there's like really been two drivers of growth in RWAs. So one is Athena and the tokenized carry trade. I consider that RWAs just because it's being generated off chain on a centralized exchange and pulled on chain. But kind of putting that to a side, the real other driver was tokenized treasuries. And to your point, like I see it being a function, or I should say the tailwind last year was the fact that on-chain rates were lower than treasuries for most of the year or very close. And like we're starting to see that change. On-chain yields are obviously rising. And so it kind of creates a headwind for what was that initial growth. With that being said, like I don't think these things are dead in the water. I just think they have to find a new reason for people to hold them. And we see like there's still ample reason to want a tokenized treasury. I just think those reasons are changing. It's not just for the pure yield. So you're basically going after idle capital now. So we can see some like centralized exchanges wanting to integrate some of those tokenized treasuries for part of their backing. I guess we can say it. If you're going to hold stables anyway, why not hold a tokenized stable or that generates yield? Similarly, if we have venture funds or liquid funds that are also sitting in stables, it makes sense for them to diversify into something that's earning at least a little bit of yield. So those are two use cases that are pretty big. So I think they can continue to grow, just maybe with a different user base. Also, I think when we have that changing yield environment, so if we have TradFi yields coming down, DeFi yields rising, all of a sudden DeFi yields start to look really interesting to maybe like a small hedge fund that can get this 30% by plugging into DeFi. So I think RWA protocols that have kind of already built that joint infrastructure to touch the traditional world and also touch the on-chain world have an opportunity to reverse the way that they're sending value. So right now they're taking value from off-chain, putting it on-chain. But there's a world where these yields get so enticing on-chain where we're going to grab those and tokenize, or not tokenize them, but wrap them into a traditional instrument that TradFi can buy. So that's something I'd also be interested in. I'll give Superstate like a quick shout out. They have a fund that does their own carry trade, which is really interesting. So I think it's an interesting narrative. I think the initial tailwind has subsided, but there's still a lot of reasons to be optimistic.
What do you think actually drives on-chain yields? This is the type of question I get from people who are not crypto native and are unfamiliar with why you get mid-teens and above APRs on certain DeFi protocols. And it is kind of difficult to explain because it can come from like a variety of sources. But just curious if you have any thoughts on what you think drives on-chain yields and what ends up driving the increase in the spread between on-chain yields and off-chain yields.
I think everything is a derivative of speculation, right? So I think you look at any source of yield. Okay, let's say you want to deposit into Aave, your yield's coming from people who want to lever up on a spot position on chain. Even Athena, like the that basis trade is coming from people lever longing and wanting to speculate on price appreciation. So I think virtually every yield that we get on chain primarily comes from speculation. I had another example. What was it? Oh, even, yeah, if you're farming points, you're kind of speculating on those points having value. So I think on-chain yields historically have done well during times of price appreciation. And I don't see why that would change anytime soon. I don't know, maybe protocols start issuing debt, but that feels like very far away.
So maybe during bull markets, we export our on-chain yields. During bear markets, we import off-chain yields. Is that a good framework? Again, focusing on earlier in the year, earlier 2024, I feel like MakerDAO was one of the protocols that people just like to talk about. And looking back, maybe it was a bunch of people driving a narrative that MakerDAO is something we should buy because of multiples, because of perceived fundamentals, because it's viewed as this DeFi giant that has kind of a really, really strong moat. But over time, it certainly lost a bit of the allure, and maybe the end game proposal isn't playing out how people thought it would play out. But just curious on your thoughts there. Are you still bullish MakerDAO? If not, what went wrong? And yeah, Andrew, feel free to tackle some of this as well.
I can answer first, maybe. I do think Maker was a good trade earlier in the year when people realized how cheap it would become, at the multiples it was trading at the time, just given how you could see the rapid rise in yields and Maker's shift to RWAs. Like, that was a very apparent rate of change in profitability that made a lot of sense. So I think at the time it was just it was a very good trade. But then going forward, thus far, it seems like people have soured on the rebrand. I think the narrative around it is a bit less clear. It's a little scattered. And if you think, the rate hike cycle is largely, pretty much over and starting to ease now, or at least pull back on tightening, that means rate of change wise, Maker's profitability is probably going to be flat or just not as good as it was before. I don't have a strong view on stars and how much adoption they're going to get. So that could change in the future if we see traction there, Maker stars, Sky stars, getting some traction. Maybe that changes the forward-looking thesis there. But I think it's much less attractive than it was in earlier 24.
I think, yeah, I agree with pretty much everything you said. I think another thing that I get hung up on is you take the theoretical idea of Maker, which is like a credit fund basically that can tap into all these different sources of yield, whether it's off-chain, on-chain, kind of similar to that RWA thesis we were just talking about. But then when you think of who actually has to execute on that vision, it's a DAO. And it's not I'm not trying to talk ill of MakerDAO specifically, but I think DAOs in general are just a very murky area of how successful can they be. And then the Maker endgame in my head is very similar to the Athena endgame, right? Athena eventually, I think, will diversify into other yield sources to pass back to holders. So it's almost who do you think can execute on that vision better? Is it a centralized team or a team that's still very involved, or is it this DAO? And I don't want to take strong opinions, but I think at the beginning of the year, that wasn't a question versus now it might be a little bit more.
Another topic that we covered, or mostly Kinji covered throughout 2024 was MEV, and certainly feels like in certain pockets, MEV was a fairly large talking point in crypto. And so, MEV in and of itself is kind of complicated, kind of opaque. Not a lot of people understand it. So I guess Kinji, should we even care about MEV? And I guess maybe firstly, what is your definition of it?
Yeah, so I'll start with the definition, which is I see the value in a transaction. So any on-chain transaction having two parts. So the first part is what is the user willing to pay for execution? So what are the fees I'm willing to pay on Uniswap? Then the second part is this intrinsic value, which is what additional value does this transaction create that someone else wants to capture? So that's the MEV part. So for example, if I'm doing a large swap, it might create an arbitrage opportunity. That's that intrinsic value. That's the MEV. I think in terms of should we care, is it important? I think for most like retail users and a lot of the people who are speculating on chain, it's not a big deal because when you're going to buy a token, you're expecting it to 10x or you have dreams of it 10xing. So if you lose 5% to slippage, who really cares? But at the same time, that 5% slippage is going to matter to the people, to TradFi, to the huge pools of capital that we want to eventually get on chain. So I don't think it's hurting the current user base to a point where they care. But if we want DeFi to be successful, it is something that needs to be addressed. And I kind of like that we're starting to look at it now with some of the solutions that are coming out.
I wanted to ask a question about why people are bringing up MEV when it comes to like L1 valuations. Do you have any thoughts there, or should we just skip that one?
Andrew, do you have thoughts? I don't like it, but I don't know if I could defend it that I don't like it.
I feel like we just touch on MEV. I feel like probably better to move to DEX stuff.
Yeah.
Should I ask what are the potential solutions for MEV so you can talk about AS and Intense?
Yeah, sure.
All right. So I guess if we've identified it as a potential problem, what are some solutions you're seeing being proposed for MEV, and which do you think have a realistic chance of actually helping to somewhat address the issue?
Yeah. So the two main solutions that I think are being proposed right now is an intent-centric architecture, we'll call it. So that's basically where you're auctioning off the right to execute a transaction to a solver, which is kind of like a market maker, basically. And what that does is right now in the current transaction landscape, the order flow is a commodity and the block space is the scarce asset. So we are having to, or the solver is having to bid up in gas fees in order to win that scarce asset. Intent-based protocol, the order flow itself becomes that scarce asset. So solvers now have to bid up the right to actually capture that order flow and put it into an ARB. So that can be captured by the protocol at the protocol layer or passed back to the user, which is interesting. And then the other solution that we're seeing is a lot of dynamic fees. So MEV typically gets worse with volatility depending on what the use case is. I'm talking LVR here mostly. But if you add a dynamic fee to the cost to do a transaction, then some of that can be captured. Or basically it's raising, the proposed solution is dynamic fees. So if you have high volatility, let's say, that might create a higher arbitrage opportunity in a DEX. And rather than auctioning off the right to rebalance that DEX, you just make it more costly to swap it there. And so that kind of does the same thing of passing fees back to LPs or to users. I think those both work for MEV mitigation, but personally, I like the intent framework better because I think intents also have benefits outside of just MEV recapture. Like we've talked about chain abstraction and intents sitting there. So, can we get a better user experience? Well, intents can help get a better cross-chain user experience. Can we aggregate global liquidity? Well, intents can aggregate global liquidity. So it's not so much that just for MEV mitigation, I like intents more than dynamic fees, but I think intents just give you more benefit in general. All right, I think that covers the first half of the year pretty well. Maybe we should move on to the second half. It feels like a lot of the attention in the second half of 2024 was around DEXs. So maybe Sunny, you've covered that a lot. Do you want to give us a little overview of what's been going on?
Yeah, I mean, I think the conversation always shifts to DEXs when there's a ton of speculation and a ton of swapping and just a lot of transaction volume in general. And so I'll break it down into spot DEXs versus, derivative DEXs, which are mostly just perp DEXs in crypto right now. And so both spot DEXs and derivative DEXs were able to improve their share against centralized exchanges throughout the year. And so spot DEXs more modestly so, start off the year around, 9.5%, a little under 10% share against DEXs, ended the year closer to 14. And so some modest improvement there, which might seem small, but every year we continue to improve that metric. And it's just a great growing indicator that we are raising the value proposition for coming on chain. Derivative DEXs were probably a larger story. And so at the beginning of the year, according to DeFi, or according to the block at DeFi Llama, futures DEXs had around 3% share against centralized exchanges. Towards the end of the year, we saw that basically double and move closer to above 5 and closer to 6%. But for perp DEXs in general, or derivative DEXs, they increased their total volumes from January to November versus the year prior, 328%. And so really impressive growth for perp DEXs overall. And I think to sum up some of the trends for the year, I would characterize it as a year of new players taking share from incumbents. We saw that happen both in the spot world as well as in the perp DEX world. And there were also some experimentation with both new types of DEXs. I cited Polymarket as an example of a new kind of exchange that really took off this year, as well as new types of exchange applications or exchange front ends finding product market fit. And so I think the best example of this were really the trading bots. So Photon, both the Telegram trading bots and the trading interfaces, Photon, Trojan, BonkBot, Banana Gun, just really, really impressive numbers from them. And they're slowly turning into just a crypto cash cow. I mean, these are really, really great businesses.
So we talked a little on-chain spot, a little perp DEXs, but maybe we should dive into the winners there, which feel like it's pretty clearly Aerodrome and Hyperliquid. Do you want to outline what do you think drove their success in the last year?
Yeah, I'll start with Aerodrome, and I'll sort of loop Velodrome in as well. We've covered them quite a few times. They spawned out of the same team. They're currently run by the same team, basically employ the same mechanics. It's just one is on Base, Aerodrome, and Velodrome is on Optimism. And I think there just hasn't been too much innovation when it comes to AMM spot DEXs and how they work. And so Velodrome started building in the bear market, which has been a trend. Hyperliquid was also built around the same time. And we're seeing them get their flowers now. It's really showing through in the metrics. And again, I think it just came at a time when we just kind of took Uniswap dominance for granted across EVM, across ETH2s and on the base layer. But there was some serious room for improvement, and I think both of these protocols are delivering. And so Optimism, or both Velodrome and Aerodrome, have now won volume share on their respective chains, which is a pretty big development. And that turning point happened, somewhere around the middle of this year in spring for both of those protocols. And we haven't seen the V33 model work, but this is sort of like a refined version of the solidly VECRV token model combined with a highly performant DEX that matches the capabilities of Uniswap v3. And so when you combine the factors that I just listed, you have new DEXs that are able to, these DEXs are able to incentivize liquidity faster. They're more reflexive on the way up. They've basically got this token which has utility that investors want. It pays real yield, and they can use that token in their DEX economy to help incentivize growth and productivity. And that third leg of value has really made all the difference. And so we're really starting to see them run away now with volume share on Base and Optimism. And I think the gates are open now, basically. I think there'll be more experimentation with tokenomic models, with DEX economies, with DEX designs to try to catch up and make up some ground across EVM against Uniswap. But so far, it looks like Aerodrome and Velodrome are the new winners in spot. Yeah, maybe you ask a follow-up question here about Aerodrome, and then we just talk about Hyperliquid in its own section. So Andrew or Kinji, like the emissions question?
Okay, so it seems like there's quite a few people nervous about the VE33 model and Aerodrome's high rate of emissions. I know you covered this in your report, so maybe you could clarify what people might be getting wrong there.
Yeah, I think we just have some PTSD, some 2021 Ponzi hangover, where we just see high emissions and high yields and automatically assume that it's extractive and that it won't work and that it'll end up dying over time. But emissions in and of themselves are not bad. They're just an input into a larger economic model. So, companies emit shares to help, pay for employees and incentivize productivity from them. Bitcoin emits BTC every block to help incentivize miners and drive productivity and security for the network. And so in the same way, I think Aerodrome and Velodrome, their emissions are actually driving productivity on their respective DEXs. And so they're I think the emissions actually do something here. They're going into a larger economy, a larger system, a larger equation. And two, emissions themselves are just costs that can be overcome. And so Aerodrome right now is paying out 50% plus APRs to V Aero token lockers. They're growing volumes and, they're also growing the amount of fees that they're able to return to their token lockers. And I think over time, we'll start to see that Aerodrome will actually grow faster than the rate that they're emitting. which at that point it becomes accretive. And so that's a profitable business. You're emitting a certain amount of tokens, your shares are growing a certain amount every year, but you're returning more to your actual shareholders over time, or your token lockers over time. And that works. That's accretive. I think there's no reason to assume that model will implode on its own one day. I think certainly having a steady rate of emissions does make you more vulnerable to certain things. But as long as the DEX is working, the DEX is growing, token holders are happy, LPs are happy, I see no reason to see why this is a doomed framework for how to build a DEX. And actually, it's shown to be quite the opposite. It's worked quite well.
I think before we move on, just jumping in quickly, like that sounded weird. My aha moment with Aerodrome was when I was talking to you and I was saying, well, like, didn't Curve kind of disappear because of the VE tokenomics? And your take was, no, Curve disappeared because they didn't have a better DEX or a DEX that was just as good as Uniswap v3. And Aerodrome does have that DEX, so now the tokenomics can add some value. Hopefully I'm not putting words in your mouth there, but that was when things kind of clicked for me.
Aerodrome has made Aerodrome and Velodrome both. I'm just gonna associate them together, but they've made minor but impactful improvements to the Curve model, and I think those also make a difference. Such as token holders are incentivized to direct emissions towards productive pools, which was not the case for the CRV model. But also, they just have a working product that's as good as Uniswap, at least for now. We'll see what happens with future iterations of Uniswap, but they're continuing to improve their DEX product. They're building more functionality. They're making it easier for market makers. There's Aerodrome and Velodrome Slipstream, which is their equivalent of basically the concentrated liquidity AMM DEX that Uniswap v3 carries, is performing just as well, if not better. And so when you have product parity and you combine that with a better tokenomic structure, you get what has happened, which is the flippening on each of their respective chains in terms of volume. And for Curve, I think that was just one of the missing pieces, was that people were just not using their DEX. They were using Uniswap instead. And so there weren't enough fees and there wasn't enough volume to compensate for the steady state of emissions.
Got it. So should we move on to Hyperliquid? Thank you, Jeff. Why do you think, I guess, in your view, you've covered it a lot, Sunny, why has it been just so successful?
Yeah, it started off with small iterations over time, listing perps faster, just having better UX. But I think what really made the difference was the fact that they controlled their infrastructure. And initially, from what I gathered, it didn't seem like they wanted to expand the L1, the Hyperliquid L1, to anything further than a place that just houses and optimizes for the perp DEX. That has certainly changed over time, which is why I put out that second piece explaining that we should associate an L1 premium to Hyperliquid's valuation. That's besides the point. For Hyperliquid and its infra, there are just changes that make market making a lot easier on the platform. So if you're building a perp DEX on a general purpose chain, you can't optimize for market maker cancels. You can't prioritize one transaction over the other in a systematic way. Hyperliquid can do that. And why that matters is because when you're sitting on a bunch of stale limit orders, you aren't able to react quicker. So that's just one thing that leads to market makers posting wider spreads, which leads to worse execution for the end user. Secondly, they've been able to enforce a gasless trading environment, which is great for the user as well, but also for market makers. It's just nice not to be able to have to pay gas when you're placing so many different limit orders. And that also leads to tighter spreads over time. And so, initially I think those are kind of just the core principles, core foundational primitives of why Hyperliquid started doing well as a perp DEX. And more than eroded into DYDX's share at this point. They're over half the market as of speaking when it comes to perp DEX volumes. But yeah, just small things over time, leading UX. The points program certainly helped. The community certainly helped. The HLP vault was another new primitive that helped, one, provide users a place to go to if they wanted to earn some yield on their stables, democratizing market making for them. But also, it did help bolster Hyperliquid's own liquidity in its earlier stages. And so it's just been the best place to trade, and users slowly discovered that through the points program, but have since stayed.
You want to do that, Andrew?
Okay, so now that we're in the post-launch period, I think consensus around Hyperliquid is getting pretty bullish for the most part. Why do you think hype deserves, an L1 type valuation? Has there been evidence of, the team being able to attract new primitives that are going to be built on top of it? Maybe you could tell us more about why you think it deserves this like premium valuation, maybe closer to something like Sui, or the aspirational target of like an on-chain BNB.
Yeah, I think there are a lot of protocols coming out and branding themselves now as like on-chain Binance. I think Hyperliquid is definitely the closest. And there are a lot of primitives here stacking on top of each other that I think just make it special. Like, I guess that's what I'll call it. But I mean, first of all, if you look at what the prevailing perp DEX was before, it was DYDX. And at the time, they had their order book matching engine off chain. I mean, I think it's pretty consensus that order books are better for facilitating perpetuals on chain. But the connotation at the time was, we can't build a performant enough product by having an on-chain order book and matching engine. And Hyperliquid came in and basically built everything entirely on-chain in a transparent manner. And so you can go on now and see the order book and see what's happening and verify that the transactions are happening on-chain. And that's big if you're a liquid fund or you're a venture fund and you want to invest in a perp DEX. Why would you invest in something that has a portion of its operations off chain, which really adds no serious, stepwise improvement over alternatives on centralized exchanges like Robinhood? I mean, they can still front run orders. They can still do PFOF. There are all these things that you don't fix by having an off-chain order. And by bringing that order book on-chain, there's a clear argument you can make now that this is basically the infrastructure that you want to lay for the perp DEX that is going to be crypto's highest volume on-chain perp DEX going forward. And so that's the perp DEX side of things. I think we've slowly seen Hyperliquid evolve into becoming a broader layer one. So opening up its L1 to other devs who want to build on the L1, adding EVM compatibility. And there are all sorts of benefits that you get from one, just being in close proximity on the same chain to the leading on-chain order book in crypto. There's a lot of composable applications you can build there that fits in quite nicely. Athena-like protocols, options protocols, and the infrastructure itself is just highly performant for DeFi applications. But also, they have this large community that's growing every day who are, one, quite degenerate. They're trading perps on chain. They've been there for a while. They do a ton of volume. And so these are people who are quite savvy or at least know what they're doing. Not enough to not lose money, but enough to basically be a high value DeFi customer or a potential high value DeFi user. And they're passionate about Hyperliquid. And so, over time, I put out a market map. I called out 30 plus teams that are planning to build on the Hyperliquid L1 once the EVM goes live. I think that number is probably larger just because there definitely are teams that haven't publicized that they're going to be building on the Hyperliquid L1. But then you slowly start seeing it become, in terms of users, in terms of activity, in terms of applications. I mean, no other L1 has, very few L1s have an application as great as the perp DEX itself. And so I think people will slowly start to make a case over time that it should be a top L1. And TVL already has moved into the top 10 category for L1 TVL. And I think we'll continue to see more development there. And L1s are generally worth more than DeFi protocols. And so what happens when you have one of the best DeFi protocols and one of the best L1s in one protocol? So I think that's what has gotten people excited. And maybe that's why we're seeing the price action we're seeing right now.
I think it's kind of interesting that one of the main points of FUD against Hyperliquid in the beginning was like, oh, you're on your own app chain. That means you have no composability. And then by kind of announcing the layer one, they've completely killed that FUD. And I think it also points out that composability is not, like, you need a great product before composability becomes value. Like, it doesn't matter if you're composable, but you're the worst DEX ever. It doesn't add value.
And I think that matters more it matters even less for perp DEXs, because you can list any perp. You don't need to be on a chain to list that native asset as a perp product. I mean, it's a derivative product. And also people who market make for perp DEXs and also trade on perp DEXs. There's maybe a small percentage of people who are highly active on those exchanges, but they want the best execution. They want the best experience. They're not willing to compromise for that. And at that point, what's the benefit of composability if you're going to be getting, X percentage worse execution on every single trade? It just kind of makes sense for a perp DEX. And, as you said, as they grow that L1 ecosystem, you'll start seeing more protocols come in and want to be composable with that order book. And so we'll see that start to develop over time. And so I initially called it an app chain because by definition it was. And I don't think it'll be a full general purpose one, but it's sort of like an apps chain model, a leading app and some surrounding tertiary supportive protocols and applications around that app on one L1.
Makes sense. I guess before we unleash Andrew on all things CeFi, do you have any last takeaways on DEXs that you want to share or predictions for the new year?
Yeah, I think going forward, I think the attention will shift towards DeFi protocols on the best chains for DeFi. And this year, that's been based in Solana, and I expect that to only continue. And so expect more attention to come on base DeFi applications. I think Solana DeFi applications are starting to get their shine, your Radiums, your Jupiters, and whatnot. But I only see that continuing. I think we'll also see more DeFi applications experiment with whether they want to vertically integrate into their own infra, which is what Hyperliquid has done, which is what Uniswap is doing with Unichain. I think that will be a narrative to watch. And I think front ends just continue to proliferate. People like these front ends. It's clear that they don't want to be, or it's clear that there's a subsect of people that want to be trading on chain, but they don't want to be using, or they don't want to be interacting with DeFi as it is in its current form. Maybe DeFi is supposed to be the back end, or DeFi today is supposed to be the back end, and we'll all be trading on some really cool front end in the future. But I think the Telegram bots were probably the biggest indicator that there's very, very real demand for good front ends, and people are willing to pay a fee for that service. And I think we'll see more types of front ends come in. Azure is one that I've mentioned. Intense-based architecture, omni-chain. So I think an evolution of just trading bots to perhaps a more all-encompassing types of front ends that plug into DEXs.
All right. I like that vision a lot. I guess for anyone who listened this far, you'd think that on-chain trading is like the dominant form of trading, but in actuality, it still mostly happens on centralized exchanges. I guess, Andrew, what have you been seeing in the SEX landscape over the last year?
Yeah, so for as much as we talked about Hyperliquid and Radium and all these other DEXs that are doing volume, Binance is still king right now. It still dominates spot volumes with a 25% market share. But on the SEX front, most exchanges spent a lot of the year playing a different game than Hyperliquid, just developing, a really high performant perp DEX. So the exchanges spent time on a few fronts. A lot of it was regulatory. So you see Binance, Bybit, they're all getting licenses and like complying with new regulatory frameworks in other countries, particularly Dubai, Singapore. They also spent a lot of time in the courtroom in the US. So, they're either pushing back against the SEC or coming to settlements like Kraken did with its the staking services that it was offering. They also spent time developing their on-chain integrations, which are still kind of in their infancy. Coinbase is launching smart wallets that will be an improved user interface. So basically get rid of seed phrases for the average user. You can just use your passkey on a local device. So like your Touch ID or Face ID on your Apple devices, which kind of streamlines a lot of things. I don't think the average new on-chain retail investor really wants to be writing down seed phrases and losing all of their funds one day. But yeah, and then Bybit, they're trying to improve like a more seamless on-ramp into DeFi protocols. Binance and Bybit both started doing pre-market trading for before TGEs, which started seeing a lot more volume, and they make separate deals with teams to have exclusive pre-market trading usually. And then obviously they are all competing on having the best trading features. So one thing that Binance did this year was implement perpetual futures funding arbitrage that you can do on a ticker in a single click, which is pretty cool. They all have different various growth initiatives. So they're all competing for these like super high volume users that are trading millions in per volume every month. And so they have these special VIP programs, bonuses, rewards for staking, and the like. So yeah, definitely a different game being played among the dominant players. They're still competing for volumes and trying to eke out some competitive edge anywhere they can.
What do you think about some of these sexes making deeper pushes into trying to be more integrated on chain or just having more functionality on chain? Maybe even like I'd throw listings in there a little bit because they're kind of trying to appease. I think they're recognizing that people are buying whatever it is they're listing very, very late. And so, we've seen a ton of meme listings across major sexes. So maybe they're trying to move a little bit up the curve there with the regulatory easing. Just thoughts in general of centralized exchanges trying to appease the crypto native customer or just pushing more people on chain.
Yeah, I'm a bit skeptical about their efforts, at least for like the Binance and Bybit types outside of the US. I'm a bit skeptical about how much volume they're going to drive or how many users they're going to drive on chain through their various integrations. I think Coinbase probably has the best shot. Like I think they have the most developed wallet architecture, and just like it's just such an easy on ramp for people, for the millions of people already on Coinbase, to transfer funds to Base pretty seamlessly. So I feel like probably most bullish on that bridge between Coinbase and its L2. As far as listings go, that is one area where they're going to continue to compete on for volume and mind share. And we've like post election, we've already seen Coinbase, Robinhood all completely change their listing strategy. They're listing memes like every other week now, and I don't see that stopping. I think they have obviously seen how much volume they're trading, and they want a piece of that coin on Coinbase, and then they're like, wait, can I buy this new meme or this other token that someone told me about, but it's not listed? Are they going to go out and set up a wallet? I'm not sure. It would be interesting to see numbers on how many people like kind of fully make that transition. Obviously, at one point or another, like we've all done that like years ago, but I wonder for the people who saw Bitcoin go to 100K, they re-downloaded Coinbase, how many of them have gone through this little phase of like speculating and then actually started digging into doing stuff on chain? I'm not so sure about that.
I definitely think there's this like wall between hardcore sex users and hardcore DEX users. Clearly we thought they'd be buying our memes. I don't think they have been. I don't think Whiff has caught a bit yet on Robinhood or Coinbase, but XRP certainly has, and that's something that crypto natives was just not. We just weren't expecting that at all. At least most people, and so there definitely does seem to be this clear divide between retail on centralized exchanges and retail on decentralized exchanges, or just people that are on chain.
Do we think that that divide is like risk appetite, knowledge, or just like poor UX? Like, are we just willing to put up with a terrible user experience? Are we just way more degenerate, or are we a little more curious?
Yeah, I think there's a certain type of person that moves on chain. There isn't really that compelling of a reason to move on chain right now. If like all you're looking for is to just buy some stuff, hold it, make some returns if you want access to BTC, whatever. But there definitely is just like a small portion of people who maybe they're more degenerate, maybe they're more curious, who just find their way on chain somehow, some way. And the people left on centralized exchanges probably just think and act in a different way. I mean, that's at least my explanation for it right now. I think as more applications come out that people want to use on chain, as we get easier on ramps, like what Coinbase is doing for Base, better wallets, eventually we'll start seeing more crossover. But right now, it just seems like two completely different worlds. Let's talk about stablecoins. I think there's been more PMF this year gained for stablecoins. I think stablecoins is slowly moving. Stablecoins are slowly moving to that Bitcoin camp of these are almost the guarantees now of crypto. We've seen adoption abroad. We've seen adoption, in other places for a wide variety of different use cases. Can you just give us some of the highlights there and maybe touch on stablecoins from a CeFi perspective as well?
Yeah, so 2024 was obviously a giant year for stables. Total market cap surpassed its 2022 highs and is now sitting around $200 billion. Monthly stablecoin transfer volume is recently reached more than 3.5 trillion, which is like already rivaling or surpassing traditional payment networks like Visa. And we know that like a huge portion of that activity is people just using stables for everyday purchases, remittances, or businesses doing cross-border payments, because the activity is largely uncorrelated with, BTC moves or moves in majors for the past 2 years. And so stablecoins more broadly are becoming this very unassailable thesis and like use case that, you know, it's unquestionably good for everyone. Why is this? It's, well, stablecoins run 24/7. They have near instant settlement. You know, fees for sending dollars cross borders can be an order of magnitude cheaper than using a intermediary bank or a credit union, especially in emerging markets. And obviously, you can also tap into that composability aspect on chain in DeFi products, but I would say that's not the primary use case for like why stables are doing so much volume, but it's still a plus down the line. And so yeah, we're seeing a huge surge in activity in emerging markets in particular. And so I covered that a few times this year. A lot of the activity is occurring with Tether on Tron, which I think most people in the West and more developed markets probably haven't heard as much about or just haven't used themselves. Um, but yeah, USDT on Tron, and then also Tether just being swapped on centralized exchanges through fintech apps like Yellow Card. These apps and sexes that have basically converged on being a pure stable swap platform. They now have millions of users, and they're using crypto rails to swap out of their local currencies and just send money across borders very cheaply. And now these new apps that, you know, have gained popularity as payment apps or just apps where people hold value in dollars, they're now looking to expand their services beyond consumers and now focus more on the B2B market. And so like small businesses paying suppliers in different countries, they can just get instant settlement instead of waiting for their funds through banks, which could take, you know, multiple days, and they have their working capital tied up. So that's why you're seeing large acquisitions, like the Bridge acquisition with Stripe, because all of the current, you know, incumbents in the payment space see how disruptive this infrastructure is going to be.
Are there any new types of stablecoins or new stablecoin players that you think can legitimately challenge the circles and the tethers? I mean, I feel like there's been very many attempts so far, but I just don't see where they can add value.
Yeah, I think there will be plenty more iterations, and we've already seen some, like with Elixir's USD, which kind of plays with the Athena model. Just has some like tweaks in how it implements that cash and carry trade. So that's it. There's going to be a lot of interesting like design tweaks. It's really hard to replicate the level and scale of distribution that Tether initially got through centralized exchanges like Binance. Like I just think that moat is not something that is easily taken down. And you know, people getting used to using Tether as their margin collateral on exchanges, people in emerging markets like using Tether on Tron without even really thinking about it. They're not looking for alternatives. Like they've used it for years, so they don't really have much of a reason to switch to something cheaper. Like even other reputable stable coins on L2s, which are often cheaper than transacting on Tron. Like no, the people using that on the back end, they don't really care that much because the fees right now are already an order of magnitude cheaper than any alternative option available in their local with their local currencies. So yeah, I'm not bullish on chain stable innovations necessarily. Like I don't think any of them are going to reach that scale, but I think it's definitely worthwhile for people to, or like teams to pursue different primitives and like design choices. I do think like Athena itself is going to continue to do pretty well, as we talked about earlier. Just funding rates probably going to stay hot, and if, you know, Athena the protocol starts, you know, flips a fee switch, that becomes very attractive as well. I think I also covered briefly like PayPal's Pi USD, and a lot of their growth in 2024 was mostly incentive driven. And once they like turned off the faucet on most of those incentives, we saw like their Pi USD market cap almost got cut in half. So it's going to be tough for new centralized stables to like actually take share from the current incumbents, and it might cost them a lot to actually acquire some users and get some sticky behavior going on there.
I feel like stablecoins have kind of, at least this year, especially in emerging markets, have kind of almost eaten away at a few of Bitcoin's original use cases, which were store value, potential medium of exchange, cheap to send, permissionless to send and hold. But it turns out like the value is actually still in the dollar for the most part, but crypto rails just provides maybe the best experience for both getting the dollar for people who are outside the United States and also sending the dollar, transacting with the dollar, both peer to peer and peer to business or business to business. And so
Yeah.
it's encouraging.
Yeah, and I don't think it's a bad thing. It's like I think a lot of crypto native people harp too much on the dollar being, a terrible store of value. But like obviously we're not all just sitting in cash over time. Like otherwise you're not a great allocator of your own money. But like the dollar's still king, like globally, like, as a share of Forex reserves at central banks, as a share of exports and just overall like foreign exchange transactions, people want to hold dollars. And to someone in Turkey, Argentina, and Africa, being able to easily swap into and hold dollars as opposed to local currencies, like that is a huge value prop.
Yeah, so right now the dollar is still better than their other option, which is just hold their fiat currency.
Yeah, so like it's a huge value prop, which actually, once stables reach perhaps an order of magnitude greater scale, like we're in the multiple billions, it might actually start becoming a problem for these individual countries in emerging markets where, residents just don't want to hold their own local currency, and that's going to probably cause problems for those countries' central banks. But for now, it's just an incredibly valuable use case to people abroad that is probably underappreciated in the US, where obviously and in Western countries where you have fairly easy access to dollars.
Yeah, it's actually feels like for the time being, crypto has actually improved or strengthened US dollar hegemony instead of weakening it like some people thought it initially would. Yeah, maybe eventually they'll figure out that Bitcoin is better than the dollar.
Maybe another 10 years. We'll get there.
Okay, so I guess to wrap up here, last year there was a lot of talk about a DeFi renaissance, of DeFi kind of roaring back after a period of underperformance. Do we think that is a real narrative that is going to take place in 2025?
I think the regulatory overhang coming off is definitely it definitely benefits DeFi more so than probably any other sector in crypto. All these questions about value accrual to tokens. Hopefully we see that addressed somewhat. All these lawsuits, hopefully we see that stopping. Just more encouragement overall towards the sector. I think DeFi will probably get outsized benefits if Trump continues to ease, or if the new SEC administration continues to ease there. I think asking if 2025 will be the year the market decides to care about DeFi fundamentals, I'm not sure. That might be too hard of an ask. But certainly if we do care about fundamentals, DeFi probably has some of the best fundamentals in crypto. I mean, Syncrasy has talked about this quite a bunch, where if you look at the highest fee earning protocols in crypto, you have like ETH, Solana, TRX, the blockchains, and then mostly DeFi applications. And so these are still the cash cows in crypto. They're still making money. They have PMF. I think the big issues for 2025 will be, will the constant barrage of regulatory attacks stop? And will we ever figure out how to fix value accrual?
Yeah, I think, just yesterday we had Trump's crypto venture, World Liberty Financial. We saw their wallet buy ETH, they bought Aave, they bought Link. Aave was up 20% yesterday. Their metrics are up and to the right. Just saying that out loud, that like the president's crypto venture, their wallet bought all of these DeFi tokens, it's just such a flip on its head from the environment that we have been in for the past 4 years. And my guess is that the market has yet to fully digest, those implications. I do think there's going to be good pockets of outperformance within DeFi. Even things like Lido are trading as if the ETH ETF might get staking approved at some point. It's up 20% today. So, and DeFi was so beaten down that there's a lot of reasons to be very hopeful going into next year. And chances are the market hasn't fully priced in that entire change in regulatory environment.
I'm like thinking through this in real time. I kind of feel like DeFi is going to benefit from asset selection, where the whole pie as a whole might still kind of lag behind these new exciting use cases like DePIN and AI. But we are hopefully going to have some incremental innovations at the protocol level or at the application level, where if you pick the right application that can overtake an incumbent or unlock something new, you can get some great outperformance there. I also feel like in general, like finance is much larger than just speculation. But in DeFi, all we have is speculation at the moment. So hopefully some regulatory clarity can help bring new DeFi use cases that weren't allowed in the past regime. Like, what if we get enough liquidity on chain where someone can IPO there, or you can have some issuance of debt, which definitely you couldn't do in the past regulatory regime. So I think it'll be an interesting time, but I think asset selection will still be important. But it's crypto's best use case and something to always pay attention to.
Yeah, I think liquid funds will help as well. I think just more mature capital, more sophisticated capital that needs something that they can write about in a blog. DeFi is still probably the best thing, best place to go. And I think Airdrome is just a perfect example of something, or of how early that capital is to DeFi and to exploring new DeFi protocols. I mean, there's Aave, it just has so much mindshare, but Airdrome is the best DEX on probably the best place on ETH to have a DEX. They're killing it from a fee perspective. They fixed value accrual, but it's still trading at a very, very moderate multiple. And so I definitely think some re-ratings for specific applications are in store. DeFi
awesome.
Renaissance is real.
DeFi Renaissance.
DeFi Renaissance.
Hot air rises. All right.
Thank you, Jeff.